What is up, everybody? Welcome back to another episode of Real Estate Served on the Rocks. My name is Charlie Sardelli, and I'm here with
Jamison Amaros with Fathom Realty.
Oscar Ibarra, also with Fathom Realty.
who would have known? We're all with Fathom Realty.
Charlie, are you with Fathom Realty?
I am also with Fathom
Wow.
Realty.
And we are collectively what? The Mile High Perspective.
That's
the
right.
Mile High Perspective.
And I don't think we've ever disclosed who we worked for.
No?
Well, early
it's
on,
in
in the
I think
early
early on we did.
Yeah.
yeah.
Early
Well,
on.
early on, I wasn't with Fathom.
True.
I was still.
But-
I had a real estate firm.
We're all part of the game, and thank you guys for coming back to what Jamison coined as the Blackjack episode, number 21, baby.
Episode 21.
So you know it's going to be a good one. You know it's going to be hot and heavy as always.
It's going to be a bit confusing. I'm
well-
not gonna lie. Even for us, we're like, but does it go up and down because of this or because of that? So with that said, what are we talking about?
We are going to try our best as three plainly members of the United States to describe to you factors that influence interest rates, because we know you guys are seeing titles pop up and news articles like these ones here, and it's scary, right? You don't know what to think. What's going on? Should I buy now? Should I not buy now? And we've talked about this before, but again, we want to bring you guys some peace and give you the opportunity to understand a little bit better why interest rates go from, maybe a 3% to a 7% down to a 6%. What does it mean over 2 months? Whatever it is. So, and if you don't know about it, it's very confusing. You don't know why it does that, right? But luckily, with this episode,
As a collective, I hope we can either confuse you further or bring some clarity.
I think we're going to do a good job.
Yeah, we're going to try. We're going to try.
Reaganomics, baby. We're talking about
What,
Reaganomics.
Make sure you guys hit us up on YouTube.
Yep.
Like, subscribe, follow, comment. The Mile High Perspective. That is where we're at. That's where you can find us.
Yep. And thank you guys so much. We just crossed 40 subscribers.
Yep.
Like that is awesome.
Yeah, I'm excited, man. It's
Yeah,
41 people are like, these guys are
Okay.
right.
They're good. We
They're
got
cool.
to do it.
We'll
good.
follow. We'll
Right.
see what they're doing.
I'm drunk on a Tuesday night. I'll watch their YouTube channel. Hey, we appreciate you. That's
Yes,
what we're
exactly.
going
And please, guys, we want you guys to enjoy these bourbons with us.
Yep.
I know we've been working on a way to kind of give a list. I think what we're going to start doing is maybe adding that into some of the documents that we have for you guys. That way, you have somewhere to reference as to the ratings that we give it, the bourbons that we have. We wanted to do something behind us on screen, but that's not really going to help the listeners if you're
Except
not
for
watching.
like episode 12. I'll take full responsibility for the bourbon.
Episode 20, you mean?
20. I mean, yeah. Episode 20.
It was that bad. You went back 8 episodes.
Yeah, that's how bad that was. I lost a few days.
I lost 8 episodes of experience.
It was garbage. Those bourbons were not good.
well,
I'll
you
take
got
full
the
responsibility
job
for that.
done.
We did.
Fine.
Exactly. That was the whole point. Brown
Yep.
bag bourbon. This is what we're going into summer. We're going into spring.
Exactly.
Hey, we're all wearing shorts.
Let's
Look
go,
at- look
baby.
at that.
It is
whoa.
beautiful.
That's a Colorado thing. We get over 65
gonna-
degrees, and we're like,
Oh, dude.
woo, summer.
62? We
That's
went. I think we went last year to last year, the year before, to Scottsdale, and we went in like February, right? And I was pumped because it was cold here, and Scottsdale was like, ooh, it's like 68, 71, 72, and we go out there. We're staying in the hotel first day, go to brunch or whatever, and I got basically this on essentially, right? I walk out, jeans and like North Face coats.
Yeah. No.
I'm like, what are you guys doing?
The
And they looked at
masses.
me. They're like, what are you doing?
I just got back from Nevada,
Yeah.
seeing some family out there, and same thing. It was like 72 degrees.
Yeah.
I was in shorts and like a light t-shirt, and they were like, "Charlie, it's cold out." I was like, "This is amazing."
Yeah.
I just came from 31 degrees.
Oh yeah.
72 is beautiful.
And I like the cold weather. I like to snowboard. I like to ice fish. I like to do a lot of winter stuff. This year, I am over it. We've had some cold weather and no
Yeah.
snow. So it's just been freezing and uncomfortable,
Yep.
and I'm ready to golf. I am trying to
outside.
bring
I gotta
and keep summer here.
I got a
That's
new
my
golf
attire
hat
today.
on the way to my house for Tuesday.
Nice.
Boom.
I am itching to go golfing.
Right? Well, you can also tell that it got nicer out because Jamison and I have haircuts. We got it done.
I get a fresh haircut
Hit
every
that
morning.
barber, baby.
Yeah, that's right. Got to look good when you're outside
Yeah,
flaunting
yeah.
in the sun. You know what I'm
Exactly.
saying?
I hit the Bic every morning.
Barber Bic.
Oh yeah.
Love Barber Bic.
Well, guys, for today's topic, since last week we did do the brown bag bourbon episode, we wanted to kind of bring it back. And if you are a fan of the podcast and you followed us for a while, you know that we really enjoy Smoke Wagon. One, because of their story, but two, because of their flavor. So, JMO, I'm going to go ahead and let you take it off.
Yeah.
Well,
Sounds good.
before you go, it's kind of a good segue back into good bourbon
Yes.
because we left with trash party.
We're not discussing it, remember?
No. We're not discussing opening day. That was a
Did that not lead into opening day?
It did.
Ooh, that got us to opening day, and that's we were blaming the garbage bourbon on what happened, but it was crazy.
I'm so glad too, because when I met you guys for opening day, I had the rest of that Ancient Age waiting in the Jeep.
Oh, good.
And
Lord.
I did not pull it out.
Good.
I
God.
thought about taking the benchmark or whatever that stuff was, and I was like, nope. No. So with that said, it was party time bourbon, brown bag bourbon. We're dialing back with a good bourbon, but from a party town, Las Vegas, Nevada,
where they wear shorts. Oh, no,
where they
that's
wear
just us.
shorts all year round.
Yep. So what we have is Smoke Wagon bottled in bond straight rye whiskey. So if you guys have watched the show before, a couple episodes back, we did a Smoke Wagon single batch rye, which is a little bit different. This is bottled in bond. And kind of actually, now that I think about it, goes with the theme of the show.
Was the last one the malted rye?
It was the single barrel malted rye.
Malted rye.
So anytime you have a bottled in bond bourbon or whiskey, it is regulated by the United States government.
Yep.
And they do that to ensure quality. So I know we've talked about it. We've had a couple of other bottled in bond bourbons before. It's a lot of
And this
P's.
is one time it was good that the government got involved, right? Because people were going blind.
Yes, they were.
Like,
They were
we
going
need to
blind.
regulate this. People are tainting the waters with some tobacco and selling it as bourbon.
Yeah, exactly. But the thing that makes a bourbon bottled in bond is it has to be done and distilled at one distillery
And pour it out for you.
in one location during a very specific season. So it can't be, the mash bill can't come from a couple of different barrels. It's got to come from the same barrel. It has to be 50% alcohol by volume or 100 proof. And the government did that, like Oscar just said, to essentially regulate the quality of the bourbon so that it was safe for consumption, really. So
Yeah, people were drinking it and it wasn't good.
no,
It
they were
was-
going blind. Like,
yeah.
it was crazy.
It was high in proof and it was
Yeah.
just
Essentially, it's like you hear the horror stories of like fentanyl being cut with other different things.
Yep.
Well, back in the Wild Wild West,
That
they
was
were
the
doing
fentanyl
same
back
thing.
then?
That was the fentanyl back then. They were just cutting it with whatever they need to, gasoline, ethanol, just to make it cheap, right? So
yeah, what is this, unleaded?
yeah,
Yeah,
it's like, yes, it
exactly.
actually is unleaded. So I'm excited for this one. I'm a huge
Yes.
Smoke Wagon fan.
Me too.
I'm not going to go over their story again, but they are based out of Nevada. They've got some master distillers and mixers that do a phenomenal job, and they essentially they uniquely distill and blend their whiskeys in Nevada. So
Yeah, they're in the heart of Las Vegas. They are in the heart of downtown Las
Yep.
Vegas, and they also do Silver Dollar vodka.
yes, they do.
They
Okay.
do that as well.
Well, and I will say what's cool for me about Smoke Wagon, and like I drank bourbon before, but like I said, this podcast was the first time that I was categorizing them and or actually sitting down and going, oh, what are the notes, what are the flavors, stuff
Yep.
like that. Smoke Wagon was the first one that we drank. I think, what was it, the uncut, unfiltered?
Uncut,
Yeah.
unfiltered.
Was the
yes.
first one.
Yep.
That they had. This was even before I was on the podcast, and I got to taste it, and that was the first time that like I tasted a bourbon. I was like, holy shit, I got to tell somebody about this. You know what I mean? Like, Smoke Wagon focuses on their flavor, on
Yes.
the notes. So I'm really excited to see, especially with the bonded, to
Yeah.
see how it is with their regulation, because a lot of their stuff I've found is very unique and genuine in how they structure it and how they distill it. So I'm really interested to see how they do something that's regulated in this
And
way.
apparently, this is a different mash bill than the malted rye, even
Yes.
though it is a rye, but
So-
it's a different mash bill.
With rye, it's 51% rye. With this one, it's 49% corn. With the malted, it's 49% malted barley.
Right.
And
Yeah.
that's the biggest
Yeah,
difference.
so
Very
very
cool.
But to go to your point, right? We talk about government regulations, which is going to
Lead us in.
lead us into our conversation today.
The
So
government-
here's the straight up, like, if I'm going to bottle and bond a bourbon, this is what it needs to happen. And this was done they decided this in 1897 is when the Bottle and Bond Act was passed by the United States government. So they have to have it aged at least 4 years. It has to be bottled at 100 proof. The bottle has to identify the distillery, where it was distilled, and if it was different from where it was bottled, it also has to disclose that. And it has to be aged in a federally backed warehouse.
Nice.
So they
Wait.
make sure that, like,
So
it's
Which all the stories start tying together. Larceny.
Yep.
He was an agent. He was a bond agent.
Yep.
Yep.
So it all ties together.
exactly. Well, and I think it's funny. You said at a minimum of 4 years. those two that we had
We
last
don't
week.
talk about it.
We're not going to talk about it. We did make that phone call.
Those should have been bonded.
Those should have been trashed. We made the phone call to Ancient Age and left them a message, and they did return the call.
And check out the YouTube channel because we're going to have
It'll
that video
be on
put
there.
on there
It
just
is
for fun
hilarious
for you guys.
because we basically said that their whiskey was trash, and then the phone call we got back from some lady in somewhere in the southern United States was like, "Thank you for enjoying our whiskey." I'm like, "You didn't listen to the message, did you? Because we did not enjoy it at all."
I thought this was the complaint box.
Yeah. We put the wrong.
Yeah.
Anyway,
Well,
this
now
will
that
be
it's
better.
been open for a little bit, we poured it out. Let's go ahead and give it a try.
Cheers, baby.
Cheers.
Put my pen down.
I will say right off the bat, though,
Better than last week.
well,
100
but
million
just
times.
some of the other bourbons that we've had in the past that were a little bit higher quality, I felt like the smell kind of did the cartoon grab. I can tell this one's a lot more contained, which means as it opens and as it sits, it's going to get even more flavorful. So I'm excited
And
for it.
I mean, just look at the color. Like
Good. It's a really nice amber.
Amber, yep, exactly. I think what's his name could find a bug in here.
Little-
Start Jurassic Park.
What is his name?
Sam-
the guy from the
Sam
Fly?
Neill?
No.
I don't know. I'm
Oh,
not
you
good
know
with
which
it.
guy I'm
Jeff
talking about.
Goldblum?
Yes.
Yeah,
Goldblum.
yeah.
apartments.com.
Yes, sir.
Life finds a way.
I watched the latest
That
one.
guy's ridiculous. He's like 60 and has like 3-year-olds. Oh my God. I thought I was bad.
Oh my god! If I was 60 with a 4-year-old, that is
That's tasty.
That
I'm living
is-
I'm living in it. Hold on, let me see.
That's very tasty. It's good. Yeah.
Okay,
And
now I can talk.
take a
So you know
minute.
what's funny? I feel we talk about this a lot when we talk about people that are like just getting into bourbon. I kind of want to like bring somebody on like we talked about and give them ancient aged, and then immediately give them this and go, "Do you get it
Now you understand.
you understand?
Well, you have all those memes. I sent
Oh,
to
yeah.
him why I drink bourbon, and he's like, "Fuck,
Yeah.
do you really like it? It burns. It sucks. It's different. It's just different."
But I will say that this one, we didn't really look at the notes beforehand, but off the taste, right off the rip, the butter is heavy on it. Very, very sweet for bottled and bonded. A lot of sweetness to it, but again, not syrupy, not a heavy
No,
sweetness.
it's a very subtle sweet, but it carries, and it's aromatic still.
Yep.
But it lingers, and then the burn hits slightly towards.
I can feel the burn almost on the tongue, but it's complemented by how smooth it is.
Yeah,
Well,
and then this definitely carries those floral notes
Oh yeah.
The-
at the end.
The notes online said sweet, black pepper, cinnamon, spice, creamy, rich fruit, and candy notes.
Yep.
I get the candy at the beginning and the middle, but definitely the pepper at the end for sure.
Yeah. It's they make such good bourbon.
And
They
I
really
will
do.
say though, and that's the thing that kills me. Like Jamison just said with the difference in bourbons. Thing that kills me about people who don't drink bourbon regularly is they'll open it and their gauge of quality goes off of how much the burn is. You know what I mean? And what was the proof on this one?
100.
100, right? So 50%.
Yep.
That's going to singe a couple nostril hairs. You know what
Yeah.
I mean? But it's getting past that. And once you do, and you acquire the taste for it, I know. I don't want to eat something or drink something. I have to acquire a taste for it.
Well, and it's how you drink it, right?
Exactly.
Because is it bad that I don't really feel the burn anymore? I mean, we've had bourbon
Yeah.
so much that I guess it's my mind already knows it's going to be there, and I don't really notice it. But we're not shooting it.
No, but it's like
We're not just taking it back, and that's always going to burn. I don't
This
care
is
what
gonna
you
get
drink.
so
You
good as
sip
it
it, and
opens.
it's good, and the burn is there, but it's not like. I can't
No, but it's
talk."
like it's the same thing. We have people that like spicy foods, right?
Yeah.
Like
Oh, I love spicy
You know
food.
what I mean? After a while, you get so used to it because you do enjoy it.
Yep.
That
Then you look for the flavor of
yeah,
the
exactly.
burn.
Then you have a habanero.
You know what? That's the
salsa
best
or something like that.
analogy.
Yep.
You know what I mean?
That I could think of.
Dude, perfect example is your salsa that you make.
Oh, that stuff is delicious.
Fire,
Right?
by the way.
But it's fire.
It's fire. But like we were in the Ozarks and it was people were just eating it, and it's not for the faint of heart. But if you enjoy
Yep.
the nuances of like spicy food, it's fantastic.
Well, and I'm going to be 100% honest with you. I a lot of people be like, oh, you think you're better because you drink bourbon? You think you're some sophistication?
Yes.
Yeah, 100%. 100%. But that is not off of the basis of a societal standard. That's because for me, in my mind, and what I believe to be something that makes me happy and that I enjoy seeing in myself is I want to sit down with a good glass of bourbon, a cigar, people that I enjoy, And yes, if I can actually sit down and talk with them like this about bourbon, abso-fucking-lutely, I think I'm great because I can do that. But that's the reality that I live in. And that's what I appreciate about the bourbon is you can have moments like this. And when you do enjoy it, it makes you live in the moment. It makes you enjoy the bourbon.
And it's quick and easy.
Exactly.
I mean, there's tons of cocktails that I enjoy. You got to make them unless you're at a bar. With the bourbon, you pop open a bottle. You know where you're going to get every pour.
Yep.
It's enjoyable. It's nice. You don't have to, I mean, sometimes you drink the whole bottle and shit gets crazy, but you don't have to drink the whole bottle. You just drink
But you still enjoy it.
Well,
you
and
can
then
still
on top of
enjoy
that,
it either way.
It brings up a great point that it's not even like people think, oh, you drink alcohol for the effect. I'm sorry, but we're probably going to drink a glass or two of this, and I'm not going to feel nearly as messed up as I did after one drink of that Ancient Age.
Oh, that Ancient Age. Two drinks, and I was like, man, I'm
bringing up Ancient Age.
I
All
felt
right.
I told you guys like this is weird because it was only 80 proof, but I feel it. I feel it a lot.
Yeah, because it was not bonded. It was probably cut with
Fentanyl.
Gasoline.
Yeah, it was like ethanol. Somebody just stopped by the gas station. Was like, oh, $3.60 on a gallon. Just spritz a little bit in there.
This will work with
little
this.
87. No big deal.
This will
It's
sweeten
fine.
this stuff up.
Well, I am glad that we
Poor
have.
Ancient Age. You know what? They're probably going to be the ones like, we want to sponsor you. I was like, oh, fuck, we just trashed you.
Hey,
pretty
you gotta
bad.
start somewhere.
Somewhere,
Yeah.
right? I am glad that we do have a good bourbon to go along with this conversation today because, like I said, not only is it a hot button topic, but it's a topic that people, feel strongly about. And what I want to address right off the bat, and we talked about it before, and this will lead into what Jamison is going to talk about, is what was going on with interest rates during the pandemic and why everybody was so scared coming back out when interest rates jumped up, right? So just to put it simply, with interest rates, the reason that they were so low is because the government was telling banks, hey, we're going to support you and we're going to back these loans. We're going to buy them. So there was less risk for the banks. So they were willing to give out more at a lower rate because their money was covered. They didn't worry about it. What ended up happening was the government went, yeah, we're not going to do that anymore. So that's why you saw interest rates go from 2.8, 3.2, skyrocket back up to 6.5 in what was it, matter of 3 or 4 months?
Well, we
got up to
hit,
7.
we hit over 7 between
7.5.
March and September, April, May, June, July. So 6 months.
Yep.
We went from 3% to 7%.
Which we had most agents in the market had. We were prepping for it.
Yes.
We started talking about it in March, April.
The word on the street was interest rates are going to rise. They're going to slowly hit about 6 to 7. We hope not in the fall.
Yep.
What do they do? That it speed up. By end of spring, we were already looking at 6.
Yep.
And then it just inclined like crazy. By August, I had to take listings off because we were hitting 7.
Yep.
So they sped it up. Why?
Yep, and like I said, so that leads us into it. Like I said, the government was backing the mortgages. So the government was saying, "Hey, we got you back. If they don't pay, we got you." Right? They stopped doing that. Interest rates went up, and there are a lot of factors that play into interest rates and affect them. But what we wanted to go over is kind of pull back the veil on some things that affect it on a little bit higher of a scale. And Jamison, I believe that you want to talk about bonds.
Start from the beginning with the pandemic.
Yeah,
I
don't want to talk about them because I'll be honest, like it's a very convoluted topic. And there's a reason that during the pandemic and then afterwards there was such I'm not going to say discombobulation of information, but there were so many disagreeing sides. Some people were like, oh, rates are going to stay low, and if we hit 5s, it's going to be catastrophic. Then other people are like, well, we're going to hit 10%. Then other people are like, well, we're only going to hit 6. Nobody really knew, right? And the reason, and I don't want to overcomplicate it for anybody watching, I just want to give you guys kind of an understanding of why some of the forces that affect what interest rates do, right? During the pandemic, like Charlie was talking to, basically the government was buying those securities to encourage people to continue spending money.
It was a quote unquote stimulus.
Because yes, the fear was as you shut everything down, then the economy comes to a halt. And one of the largest drivers of a healthy economy is the housing market, right? Because you buy a house, you pay interest on the loan, you do renovations, you end up saving money, you spend money on landscaping, property taxes, all those different things, right? So the fear was, well, if the economy grinds to a halt because of a global pandemic, people are going to stop buying houses. If they stop buying houses, it's going to worsen the economy even more. And oh my God, we're going to go into the Great Depression 2.0.
Let me stop you there. You said home improvements, right?
Right.
It didn't just buy and sell.
No.
They wanted people to refinance.
Yeah.
They wanted to stimulate the economy by the workforce. If you could pull money out that's cheap, now's the time to upgrade that kitchen, that bathroom, do some landscaping.
Yep.
So what's that going to do? Low rates, I'll pull 50 grand out. Now you're stimulating the job market with construction, with landscaping businesses. So that all ties in, guys. It's not just a financial side of things. The government did that to stimulate everything because none of us knew what was going to happen. I thought my phone was not going to ring. Yep. I freaked out and I was like, whoa. The pandemic, we're not going to work. Scott Peterson, he's one of the main attorneys for the board of realtors in Denver. He went up to bat with us for us as a realtor and kept us working because it was the essential people. If you were non-essential, you didn't work. We were freaking out because, I mean, come on, we're not saving lives, but we're putting people in homes. So he went up to bat, said we're essential. All that was going on. I didn't know whether I was going to be able to show property. Where I do this full time. This isn't my part-time gig. I have to feed. I have a family.
Yep.
I didn't know what I was going to do. I freaked out. So the first week, I didn't know what was going to happen. I was like, I was prepping myself, my savings. I was like, we're going to deplete the hell out of them. Quite the opposite. Phones started blowing up after that first week. Tell us why.
Cheap money.
Okay.
That's what it was, right? It's cheap money. I mean, the opposite side of that is the average mortgage rose $731 a month between March of 2022 and September of 2022, right? So the question then becomes, okay, so what if the government is not interfering artificially? What is making interest rates do what they do? And I want to explain this as simply as possible because it is, like I said, it's convoluted. But here's the deal. Most people assume that the way the government is funded is due to taxes, which is partly true, okay? They get money from our taxes. They put that back into public works, different things. But the other side of this is the bond market. And essentially what the bond market is a way for us as citizens, as investors, to essentially loan the government money that they will then use to pay for public works improvements, budgets, all sorts of different things. Right?
Kind of like back in the day when we'd go to war, right? What did they do? Bring us your metals because we need to make ammo.
Exactly.
And that's kind of what bonds do on the money side.
So what happens is people will then give the government money by buying bonds, right? Perfect example. And then the government says, we promise to repay you a 100% return minimum on those bonds plus the interest rates. Okay. So essentially it means bonds are very, very safe. Now there's different types of bonds, right? There's treasury bonds that are backed by the federal government. Then there's mortgage-backed securities, which are a little bit different. Just like anything else in life, higher risk, higher reward.
I mean, I have a good amount of my investments in municipal bonds. Right. And that's because I know that my money is going directly towards work in the infrastructure, and that is something that is, as slow as it may be, always going to be happening.
Correct.
Well, so again, it's safer.
And when people say, well, what are the feds going to do? Everybody thinks just government, right? Well, no, it's the feds. When they say the feds, it's the Federal Reserve because that's where the money's all come from, right?
That's our monetary policy, right?
Absolutely.
Like the Federal Reserve is essentially a independent body that has a directive from the Congress, and their directive is very, very simple. Price stability and maximize employment. That's what it is, right? They do not have another directive. Their job is to essentially, when we say price stability, we mean fight inflation. Historically, inflation's at 2%, 2.5%, 3%. There's talk that the new norm is going to be a little bit higher than that, but their entire goal is how do we keep that stable without killing the job market, right? And that's why there's this delicate balance.
Is that where Fort Knox is?
Is what?
Is that where Fort Knox is?
No. Maybe.
No. Is that Federal Reserve?
The Federal Reserve is different because Fort Knox
gold, or is that where we print money?
That's where Fort Knox is where we keep our.
And I'm just kidding.
Securities.
Because that's what the wheel starts turning, right? We think the Feds, Fort Knox, or where we print our money, which we have one here.
Yes,
we have a mint here in Colorado. Pennsylvania is another one. So that's not what we're talking about. We're talking about the agency that is. Their job is to make sure that we have as much as possible an equilibrium with inflation and how we're doing, which it's not the greatest, but that's what their
and
job
at their base
title is.
level, right? Their base level is they influence the federal fund rate, which all that
Influence,
means,
that's the word I was looking for.
all that means is they set and they say, okay, this is the interest rate that it is going to cost a bank to borrow money from the United States government. The higher that rate is, the more expensive money gets. The more expensive money gets, the more people decide to save versus spend. The more they decide to save versus spend, the less money is in circulation, which now starts to bring back inflation.
Okay, and you said it convoluted, right? And this is a conversation I have with a lot of my clients. I like to let them know that there's a secondary market on the mortgage side. And I tell them, look, let's say it's the Bank of Charlie, the Bank of Jamison. And I'm a bank as well. And I said, we all have $1 billion, right? And we're lending it out and we're making interest on every single one. And that's how banks work. Well, I have other ventures that I want to go into, and all my money is lent out, all of it. I don't have anything more. Everybody has mortgages. That's where all my money's allocated. Well, so there's a secondary market in the mortgage side, which allows me to bundle up a lot of my mortgages, all these people that I've lent money out to. I bundle it up. I send it over to the Bank of Charlie and said, hey, do you have any funds available? I need $500 million. Well, you may not have him. Jamison has it, $500 million. I was like, look, Jamison, I'm making X amount of dollars on this bundle of loans. Would you like them? And he doesn't have many loans out, or he has excess money. He's like, I'll buy them from you, and he's going to make money on that. Now I have cleared up a lot of my money. Now I could go do different things. So there is a secondary market that buys loans. That's why sometimes you guys, when you buy a house and you send it to, let's say, a Wells Fargo, that's who you did your loan with, or Colin, our in-house lender. He does the loan and then he quickly sells it. What that means is this is the loan, and then Wells Fargo says, yeah, I'll collect 6% on that all day long. And so the money goes there. So within a few months or a year, you may be sending your payment to Wells Fargo. All of a sudden, you get something in the mail that says, now your bank is M&T Bank.
Yeah.
Why? Because Wells Fargo had to allocate their funds somewhere else. M&T Bank said, I like it. I'll take the money on it. I have plenty of money. Take this money. So there's
a lot
when we say there's a lot that goes on in mortgages and how interest rates are affected, there's a lot of stuff outside of the government that takes place. The government is just one that kind of regulates everything.
Which hopefully you guys, as you're listening to this or watching it and going, what the fuck are you guys talking about? This is why it's so hard to predict what is going to happen in the future, right? So
the cocktail conversation is like, what's the market going to do?
Exactly.
Well, where do you want to start?
Right, exactly. So here's why the simplest way I can explain why interest rates go up and down when it comes to bonds, because people hear about 10-year treasury bond versus mortgage rates. Here's the simplest way I can explain it. Treasury bonds, because they're backed by the United States government and they are guaranteed as a return plus interest, are the safest investment. So as people get finicky around what's happening in the economy, they will flock towards safe investments, right? That's just what it is. Well, the safest investment is the treasury bond. That's a fact. Well, if the demand in treasury bonds increase, okay, what that means is the yield that they're giving those individuals on the existing bonds in the market decrease.
What does the yield mean?
So yield just means your rate of return on what I get. If I'm going to buy a bond for $1,000 at a 3% interest rate, and then all of a sudden the demand creeps up, so now the bond prices drop, right? Or sorry, raise. Now it's gonna basically give me less of a return on newer bonds that are being issued. So the only way to now attract buyers for those bonds to fund the federal government is to increase the return rate and the interest rate,
Which
when that happens, now you've got the mortgage-backed security bonds, and those investors are going, wait a second, if you don't want me to buy these higher interest rate treasury bonds, you need to give me a higher return on my mortgage-backed securities bonds. So now the bank goes, okay, well, we have to raise those rates in order to essentially compete and attract buyers. So that is how an increase in safe investments in bonds drives the bond demand up, which drives the price up, which drives the yield on new bonds down, which now means, well, if I want to get that same return, I have to raise those interest rates. If I raise those rates or yield returns on bonds, mortgage-backed securities say, hey, I want my piece. Those increase, and now you have a parallel relationship where as bond yields increase, mortgage interest rates increase as well. And all of this is driven by the fact that as inflation increases, people want safe places to put their money, which is why we say historically mortgage interest rates follow inflation, except for in 2020 when we artificially held it down.
And so when you say artificially, it was when I think artificial, I think fake, right? But it was a very real thing because we didn't know what COVID was going to do.
Well, I guess artificial in the sense that
It wasn't normal.
the U.S. government was buying the mortgage-backed securities, right? But in order to do so and to make their balance sheets actually balanced, they had to print money. And that money came from nothing to into existence, which is why I say artificially, because it wasn't created by tax hikes. It wasn't created by job creation. It was created by the U.S. government saying, hey, we're just going to print a shit ton of money and we'll figure it out later. That's why when I say artificial.
And I know I may be going out of place here or how we want to do the
Have
show.
you been on this podcast before?
This is
This is what we do.
We're drinking.
All right.
I mean,
This is
come
what
on.
we do, baby.
So, but
It's a hot topic. We want to make sure
what
that you guys
ties in
get
is
it.
the LIBOR, right?
Is what?
The LIBOR, which is the
Yes.
benchmark of what they're giving the money at. So
Correct.
banks now have this certain interest rate, and what LIBOR? It's an acronym, right? And I had to write it down because I always forget. It's the London Interbank Offer Rate, which gives the benchmark of this is what the rate's going to be.
Essentially the federal fund rate.
Let's call it a 3%.
Yep.
Right. That's what they're getting on their money. Now the banks have to make some money, so it's usually typically 2% above that.
Yep.
So if it's a 3% LIBOR, your interest rate as a consumer is going to be 5%.
Yep.
And that's how that works
So-
across the board.
And what I want to try and do is give you the let's say the 5-year-old description, right? If you were to open a picture book, how could you break it down? And the most simple way that I can do it.
Which is super cool because at my house, I'm a science nerd. I may not know literary stuff and books and stuff but math and science is my jam. I love math and science, like quantum physics. Oh my god, I geek out on that kind of
We
crap.
can talk about it all day.
Yeah, all day.
But
that's
over a really good glass of
So my kids have quantum physics. Our story time is quantum physics. Quantum physics for kids.
For kids.
I posted something like that. That's
I did see
legit.
And ultimately, that's what we want to do with this podcast, right? Is disseminate this information in a way that's easily digestible for you so that you're not going through 80 articles like we did to figure out what the hell we're talking about.
If my
right?
kids could learn quantum physics at 2 and 5, we try to give you the information as, not to say that you're 2 and 5-year-olds, but as realtors, a lot of realtors don't know this stuff.
Yeah.
No.
They just want to sell a house, but
houses.
they need to know this and as a consumer, you need to know why. So
Right.
you're not relying on the industry leaders to give you the explanation. No, I know exactly when they say, the LIBOR went up, 2% above that, you're going to get an interest rate there and why.
So
The why
here's-
is the big question.
Right. So here's my attempt at a children's book of bonds and how they work, right? So imagine a bond is an apple and the government owns that apple. And they say, hey, we're going to sell this apple to people so they can have access to this apple. Now, 4 people buy the apple. Cool. You have 4 slices of the apple.
How about we say
Everybody's-
oranges?
Well,
Just because oranges cure scurvy and that's going to be like, I want that.
apples are easier to cut.
And it was
than
apples and
scurvy.
oranges. I'm
Right.
just kidding.
All right. First off, we haven't seen scurvy since
Because
the
everybody
pirates.
eats oranges. And you know what? Pirates didn't have access to anything. That's why they got scurvy. But if you've ever had any kind of vitamin C, scurvy's out the door. I'm just saying.
All right,
I like
so-
to throw the wrench into the machine. I just
reeling
got to
it
say.
back in. Reeling it back in. So you have the apple. You have four slices of the apple, right? Those 4 people can benefit from that apple. But as the government gives that apple out to more people, the slices become smaller and people don't get as much from that one apple. So what do they have to do? They have to make more apples. So now they grow a tree. So now what you have is more than one bond. And now that one bond that you have is worth as much as it is. So the other apples from that tree have to compete. And then now what they do with that apple is they say, hey, in order for you to buy this apple or get this apple, we're going to need you to give a little bit more. And then that is how it continues to grow.
Right. So money is fake, and we're in the matrix.
Let's
really what it is.
let's not go down that pathway
No,
because that's
no,
But at the
it-
end of the
it is
day,
good,
my
right?
biggest argument with cryptocurrency is that they're
Right.
like, it's
Yes.
not backed
You-
by anything,
there-
but the
yes.
U.S. dollar isn't anymore either.
Yeah, there is an intrinsic value,
good gold reserve.
and at the end of
No,
the,
but it's not really. It's not backed by 1 ounce of gold anymore.
Yeah,
And that's a whole
there's-
nother episode we could get on.
there's an intrinsic value to everything. And when we're talking about bonds, when we're talking about interest rates, so on and so forth, the biggest thing that you guys need to understand, to me, is twofold. Number one, inflation and mortgage interest rates will always work in tandem. As inflation increases, mortgage rates will increase. As inflation decreases, mortgage rates will decrease. Now, there's 18 different steps to get there, but that is what it is. Now, those steps could be what the Federal Reserve does. It could be, conditions in the housing market, so on and so forth. But essentially, interest rates follow inflation. That's literally it. The second thing you guys need to understand, and as you can tell, this is a very confusing topic, don't try to time the market.
Don't.
Because we do not, us three sitting here with the amount of experience that we have, with the partnerships that we have, we still can't for a 100% certainty say this is what's going to happen.
The top economist failed in February.
Dude, you could talk
that guy's super smart.
You could talk to Moody Analytics, you could talk to Deutsche Bank, you could whoever it is, right? It doesn't matter, because at the end of the day, if your situation stays the same at your house, you can afford a certain amount of house. That's it. Whether that price fluctuates up or down based on interest rates, it doesn't really matter.
Budget for yourself.
Time in the market is better than timing the market, because you will never time the
hold
market.
on, repeat that.
Time in the market will always beat out timing the market.
Because it's tough. And this episode is not for timing the market. It's to understand the market, understand what's going on behind closed doors, understand why things go up and down. Now, if you want to take that information and then try to time it, good luck.
Yep.
Industry professionals have, again, the leading one, I forget his name, you brought him up, he was way off in February. And that guy is like super smart. So it's hard to predict, but if you want a super, super easy, it's not failed proof, but it goes hand in hand. And if you want to,
and we've seen it, right?
If you want to give me shit about it on the comments, go ahead.
But we've seen it.
The stock market,
the last 3 weeks, we've seen where the inflation report has come back better and better and better. And if you look at the graph and you zoom out, since January until now, interest rates have slowly come back. Now, there's going to be some volatility, right? Yep. But I think as of today, we're at like 6.2, 6.3, somewhere around there, because it's following inflation. The inflation report comes back, and that's where interest rates go. But to convolute this and to make you guys understand like all the different factors, I think Charlie wanted to talk a little bit about unemployment.
Yeah, and what I was going to say is, as Oscar's saying, you can't time it, right? So I see many of you sitting at home just stirring, going, well, if you can't fucking time it, then how do people predict it, right? There are factors that play in, and like Jamison said, the mortgage and interest rates, inflation go hand in hand. Another one that goes hand in hand as a tell, not an end all be all, is unemployment rates, right? So just to give you a little bit of a background, on April 7th, 2023 of this year, we had the unemployment number come out, right? And from February to March, in February we went 3.6 to March down to a 3.5, okay?
Which is 3.5 what? Unemployment rate.
Percent unemployment rate, right? Now, what that means is the non-farm employment, so regular payroll employment, went up by 236,000 people, right? Oh, that's great. That's wonderful. Well, in that same month...
You guys might also hear this as job creation.
Yes.
Right? We created 236,000 jobs, which is kind of misleading, honestly, because it's not like we created jobs. It's just we had 236,000 more people be gainfully employed via a salary or an hourly basis than we did the year
and there's before. A variant here, COVID.
Well, and not only that, but
people went back to work more than anything.
Yes, and that's why if you look now, we've been in the 3% now since at least this year, since January. January we started about 3.4. Now we're kind of regulating. You can see 3.6 in February, coming back down to 3.5. But the interesting part, and again we've talked about statistics, is like I said, we gained 236,000, right? But we lost 172,000. So again, numbers, how they can be presented, headlines, you have to take a look at it, right? And when we're talking about how unemployment affects interest rates, normally how that works, and stick with me, guys, because this gets to the point where you go, wait, what?
We're going deep.
Right? First off, if you haven't been to that point yet,
we're going deep.
You have not been paying attention.
You should have expected that when I said Reaganomics.
Yeah, right. So basically, how unemployment affects interest rates, right? So as unemployment goes up or down, it gives an indicator to the market, to mortgages, banks, as to how many people are going to be able to actually pay and take out those mortgages, right? So what we see is as unemployment goes down, right, and more people are working, interest rates will rise. And that's because as more people are working and more money is being put into the economy, more people will apply for mortgages, which means more money will come in. Now, what we've been seeing is unemployment rates have been kind of level and or going up, coming down. When unemployment rates stay the same and or rise, interest rates will go down. And that is because they need to now incentivize the people that can buy homes to do so. So to put it in layman's terms and how it's easy for me to understand is when you have a high-performing economy and a lot of people can buy homes, mortgage rates are going to be higher because they can benefit and make more money. It's easier for them to do that. When you have a struggling economy and or unemployment, people cannot afford to go into $300,000 plus in debt. So they will make it easier by lowering those interest rates so more people have access to those mortgages, which then flood the banks with more income, more money.
And you may ask why? Why our industry? Because our industry is one of the only industries, unless you're out there buying Ferraris, you're not going to spend $500,000, and that's where the banks have a higher rate of return on their money.
Well, and
because if I give you a 3% on a car loan, your average car maybe 40,000, you're not going to make a whole lot of money.
Yep.
You buy a house, it is 30 years long term, $500,000. You're going to make more money on your return.
Well,
and that's why we're the front runner of what it's going to look like for a recession or the real estate industry is the front runner on what's going to happen. As soon as we start seeing our industry tank, the economy starts going down, or the other way around.
The adage is that the housing market is usually the last. What do I want to say? Going into a recession, it's the last thing. It gets hit the hardest going into the recession or a recession. Not saying that we are, but just in general.
Yep.
But it's also the
by
first,
definition we might be in one round.
It's also the first one to recover.
Yes.
Right. Unemployment's an interesting benchmark because essentially when you talk about inflation, right, at its base level, all inflation is it's too much money chasing too few goods.
Yes.
Right. It's just like
or income.
That's it. Right. So if you go to the grocery store and you've got 15 people at the grocery store and there's 3 top sirloins and all 15 people want 3 top sirloins, it's going to turn into, well, who's going to offer me the most money for the sirloin? That's it, right? So when you talk about unemployment, and this is a tricky subject because I know and I sympathize with as the Fed continues to hike that rate, really, I mean, they're going to break something.
Yes.
Right? They just are. And unemployment is one of the leading indicators of are we going to recover from inflation?
Yep.
The problem is it's going to take people losing their jobs, unfortunately, to get to that point. Because right now at a 3.4% unemployment,
3.5.
Essentially what's happening is we have so many people employed that can spend money, and we've had supply chain issues with COVID and a bunch of different things that we just have too few goods. We have to make it more expensive for people to buy goods in order to bring the price down. That's what it is.
Yes,
it is.
And it sucks.
I had like 10 different thoughts while you were talking,
well,
and this is what this episode is.
Yeah,
it really is.
And to Oscar's point, exactly. There's just so many factors that can influence it, but it's understanding that basically, when everything is going good, right? When people have money and they're spending, it is less competitive to buy a house. It is easier to buy a house because more people have money. When the economy is not doing well, it is harder to buy a house. So now these banks need to make money. And that is a very important note that Oscar brought up earlier on that secondary market, right? Everybody thinks, and I know I did before I started looking into it, is that you put your money in a bank and they save your money for you. That's not how our banks work. We work on a loan system.
They're investing it.
Exactly. You give the bank your money, that bank is then investing it to make money, right? And so that is something to remember.
That's why they offer free checking and free savings.
Exactly.
Because they're going to make money on your money.
Exactly. They want your money. Now, you hear it, and again, look, history repeats itself. Look at the trend we're going through. We now have, and we mentioned it before, the most equity, the most money in the American pocket based on their assets that we've ever had in history. And what is happening? The government's looking at that and go, oh,
Two
wow,
things,
they have
that
a lot of
and the
money.
lowest rates in history ever.
And they go, oh, people have a lot of money, so therefore they can spend it. You know, they have it. but people aren't spending because, and this is why we talked about the artificial hold on rates as a bad thing, so many people bought at those rates when, again, beginning of the pandemic, home prices were, they weren't as elevated, but they were still doable.
I bought during the pandemic.
Right? Now you have doable prices with very good interest rates. I'm sorry, but I don't know anybody in their mind that is sitting on $200,000 in good money, and then they're going to now take that money and go, I'm going to take $50,000 to $60,000 of that and put myself into an interest rate at 6.5 or 7, which now I'm paying maybe in some cases double what I was paying before.
Well, and that's one of the biggest drivers that I bought during the pandemic. One, I needed more space, but I will take free money or damn near free money at 2.875, 3% over how much I'm gonna borrow, because banks, when you pay down your mortgage, most of your money is going towards interest. The first 10 years, you are heavily loaded on the interest side.
Correct.
So I was like, free money, I'm in. I don't care if I'm spending how much money.
Right.
Go ahead.
Well, no. So you guys both bring up a really good point, and I think I want to kind of I want you guys watching to understand, and I want to kind of summarize what we're talking about. Right? We're talking about mortgage rates and what affects mortgage rates. Right? So I'm just going to kind of reiterate what we've talked about.
Yep.
So there's essentially 5 factors that influence mortgage rates. Okay. So the first one is obviously the Fed's monetary policy, which we talked about. Okay.
Yep.
We've got the bond market, which is going to affect supply and demand. We've
Mortgage
got
bond.
the rate of economic growth, which Charlie just talked about with unemployment.
But you brought up a good point a few episodes ago, the people coming into at least this state.
Dude, yes.
Money.
We've got inflation, right? So those are the ones that we're looking at. So housing market conditions, inflation, the bond market, the Federal Reserve monetary policy, and then the rate of economic growth. Those are the things that affect mortgage rates, right? What people need to understand is, when you talk about mortgages, we talk in terms of the percent or increase or decrease of mortgage application, right? So like last week, for example, we had an 8% increase in mortgage applications or mortgage demand, right? Well, the only time that people demand mortgages is when they want to buy houses. Well, the only time people can buy houses is when there's houses available. So to Charlie's point, and Oscar touched on it earlier, during COVID, you either had people that bought houses at stupid interest rates or refinance with stupid interest rates. So when you say, okay, well, how does the housing market status right now affect interest rates? It's because of this. 75 or 80%, potentially even more than that, of current homeowners in the United States have an interest rate of less than 5%, which means they're not.
Hold on, repeat that percentage again.
It's called between 70 and 80% of homeowners are less than a 5% interest rate. Okay, they're not going to go anywhere and sell their house and then go buy something else. Okay, so if they're not putting their house on the market, and I'm a buyer that needs to apply for a mortgage, I'm not going to apply for a mortgage because there's nothing either in my price range or available. If I'm not applying for a mortgage, that means that whoever's holding mortgage-backed securities are going to demand higher interest rates because they're not getting the return on what they currently own. That's it.
Trust me, it's
that's literally it.
Which and even that explanation is like, what?
That's it. Yeah,
exactly. They're going to raise the interest because they can't get more. It is a backdoor kind of.
It's not even
numbers.
Honestly, it's not even, and that's the hard part, right? When we sit here and we think, like, when we look at it from our level of society, being, I don't want to say lower on the totem pole, but just being people, being ants in the cog, right? Yeah, consumers. When we look at it from that, we go, yeah, what the fuck are you talking about? If people can't afford it, why the hell are you going to raise it, right? But at the same time, that is the nature of capitalism. Companies, businesses,
supply and demand.
Exactly. Need to continue to make money to sustain themselves.
Well, and people are going to be pissed off. They're like, well, this is why capitalism sucks. Cool. That's great. Great argument. If you guys have a solution for it, please.
Call me.
Write your local legislator. Like, it is what it is at this point. And I've always lived by the mantra of you control what you can control.
Yep.
That's it, right? So if I'm looking at buying a house, one, I need more inventory.
Yep.
But I'm not going to get inventory if the existing resale homes are not going to come on the market. And the reason they're not coming on the market is because they're locked into their interest rates. And if that happens, and now I'm not applying for a mortgage, well, now the mortgage-backed securities have to give investors a better return. And why are they dependent on investors? Because that money now funds your house and your mortgage. Like, it is a self-fulfilling cycle. And there was a comment somebody left on one of my TikToks. Colorado real estate guy, by the way, just so you guys know, that said the worst thing that happened in this country was the privatization of housing, right? Which to me is kind of
because government housing is better.
Exactly, right?
Yeah.
And that's a whole other,
I mean,
that's
dude,
a whole
call
other
me.
that's
I'll have
whole
a good conversation
and
with you.
That's a whole other conversation, right?
Yeah.
But the point was, this person was frustrated that there was a market influence on how and with how much and the different ways I can buy a house. But that's the reality of what we live in,
Yes,
right?
exactly.
And I want you guys. The reason I'm hammering this point is because at the end of the day, you have a job, you have expenses, and you have goals. That's what, from a housing standpoint, that's what it is, right? My job is this, my expenses and my bills are this, and my goal is to own a home.
Yep.
Well, you can own a home at a certain monthly payment, figure that out, and then go from there. Don't necessarily, like, it's important to understand
Yes.
the factors that influence mortgage rates and the housing market. But at the end of the day, if you or you can afford, I don't know, like, Oscar, you bought a house right down the street from me. What do you pay monthly right now?
Damn, I have to put that out there.
Yeah.
Around $3,000.
Okay. So my mortgage is $2,900 a month. Okay. Charlie, how much are you paying rent?
2,000.
$2,000. Okay. So if I were to say, hey, by the way, I'm going to sell you a house, you're going to pay $3,000 a month. What would you say?
Fuck you.
Cool. Why?
Because I can't afford that.
That's your budget, right? Cool. What's your budget? If you were to buy a house today, right now, and I'm sorry I put you on the spot, but I think it's important. What's your budget?
I could do 2,400.
Cool. So that 2,400, right, could be at this point, call it, if it's a townhome, $300,000 a month.
Yep.
Okay. So if interest rates go down, maybe it's 350. If interest rates go up, maybe it's 275.
Exactly.
Does that change your ability to purchase at 2,400? It does not.
But say it again. Drop it to him again for the people in the back. What is it? It's not.
It's not.
You said
It's not.
earlier.
I touched on it.
It's time in the market.
Yes, it's time
not
in the
timing
market, not timing the market.
And I said it earlier. I rather get damn near free money because now I can afford a higher price point than lower the price point and increase my interest rate because my money's not going to where I want it and allocate it to the principal
and
at that point.
That's the whole point. As you guys are looking and saying, "Man, do I want to buy a house now? Do I not?" You got to understand what your goal is.
Which
Because
I love being the devil's advocate. I could argue both sides of what I just said.
We just talked about it, right? We said that there's so much volatility and unknown as we've gone through the factors that affect microeconomics, macroeconomics, interest rates, bond yields, everything else. People's heads are spinning, right? At the end of the day, if you can afford $3,000 a month, you have two choices, okay? I spend less than that in rent, and I hope that inflation, et cetera, doesn't increase that rent year over year over year.
Yep.
Or I say, you know what, I'm going to sacrifice a couple things. I want to purchase a house because if I sign on to a 30-year mortgage, my payment year one is equal to year 30.
Yep.
Right? If I rent year one versus year 30, guess what's going to happen over the long run? Your rent's going to go up.
And on that note, tune into our YouTube channel because Oscar is going to do a phenomenal real estate defined on why housing as an investment.
And here's the deal. This is not me advocating you need to buy a house.
No.
Because it may not make sense to you. That's perfectly fine.
And
We
again,
talk about it all the time.
before we get off topic on what you just said,
Before we get off topic, bro, we've been
dude,
off
we're
topic
always
for a
off
while.
topic.
That's
But
no, we're doing
what
good.
goes a lot of stuff that we're talking about goes hand in hand.
Yes.
Interest rates, the stock market,
Yep.
interest rates, and rents.
Yes.
When interest rates go up, guess what? The investor that owns your home knows that you're not going to go buy. So
they're
what does
gonna
he
raise
do?
rent.
The rents go up.
Yep.
Rates go up, rents go up. So stay there for a year. They're going to add another $500 to $1,000 of the money that's not allocated anywhere, just a roof over your head, which is fine. But why else not have your own investment, which you could claim depreciation, tax benefits, all that stuff that I'm going to talk about on my
Well, and that's
short.
and the beauty,
but
go ahead.
it's also paying down a principal.
Yes.
And you could do it. Next year it's not going to go up.
Correct.
Next year
Well,
it's going to be stable until you decide what to do
And
with it.
with that being said, stay tuned with us, guys. Next week, we're going to have a phenomenal episode. We're going to bring Colin back on for you guys. And we are going to talk about not only interest rates, but opportunities that you have from lenders to capitalize.
creative financing.
Creative financing, all that
and there's
kind of stuff.
tons of it, guys.
Yeah,
Tons of it.
So we're going to touch on that next week. But I'll be honest with you guys, I think we did a hell of a good job as three random people from Colorado breaking it down.
Let me plant a seed
Do
just
it.
to blow your minds even further. and this includes you too. So the Fed money and work, recession. We can, by definition, be in a recession now. But what I tell my clients is we won't go back to 2008 as long as the workforce is good. Because that's what really tanked us, right? People started losing their houses, and then that really affected us. Go, hang in there with me.
I'm good. I'm good.
So that has a lot to do with if we're going to go back to that, right? Our job market is pretty robust and good, at least here in the state of Colorado. So we're not going to tank like that. So with that said, we said that you said 6 months ago the Feds had 60%
Of what?
of the bonds, the backed bonds.
Oh, no. So last year they owned almost 75% of mortgage-backed securities.
We're down to 30.
Yep.
Now
They've been selling them off.
Now we're down to 30.
Yep.
Work is good. What's going to happen to the rates? That's another thing we don't have a crystal ball.
But again,
the math there says
here's the deal. To Oscar's point, right? Like don't overcomplicate it. If inflation continues to get reined in, mortgage interest rates will continue to decrease. Okay. And I saw this guy. Oh man, I wish I could shout him out because he's phenomenal. If you guys want, I'm gonna give him a free plug. It's called the Data Deli on Instagram. Okay. And he's a data nerd. His name's Dave Myers. And he was talking about, hey, what's the magic number right now of interest rates where people are going to jump in to buy houses? It's anything under 6.5%. That's what it is, right? And as inflation decreases and we continue to see interest rates under 6.5%, we will see demand in the market.
Yes.
It will not balance out, I don't think, right? Because people are like, well, why should I buy a house right now? It won't balance out until it makes sense for current homeowners to sell and then buy something at an interest rate that isn't astronomically higher than what they're at right now.
and for the hopefuls out there that the interest rates are going to go back to where they were,
At 3%?
not.
Don't hold your breath.
Hell no.
Don't hold your breath.
It's gonna take another global catastrophe.
Well, and again,
do
the
we
problem-
want that? No.
But here's the problem.
That's
is
the only
even
reason it
if
went that low.
Even if that does happen, the issue is as money gets cheaper, all you're doing is driving home prices up. So
Yeah, sure.
realistically,
So you don't want that.
I would like to see interest rates at about between 5 and 5.5.
Yep.
100%.
Right?
I agree with that 100%.
Because
that's a healthy market.
If that happens, right? Yes, homes are going to be cheaper, which is fantastic, but it's going to loosen up inventory because people that have been waiting to upgrade, to downsize, to do whatever, need that sweet spot to put their house on the market to give us more inventory, and then we have a balanced market. That's it.
Yep. All right. So, like I said, I think we did a really good job as kind of breaking it down, and I think this is a really good time to lead into our one rock takeaway for the episode.
Already?
Yeah.
I got more shit to say.
Check out Oscar's real estate defined videos.
I have a whole lot more to say. It'll blow your mind.
Oh no,
Right.
so do I.
And it's a hard one. If you guys
Just
want to
the
Maybe we'll
market
do a
alone.
one-on-one, like back and forth.
Yeah.
Stat guy creates stats. We got shit going.
Yep. All right. So
Hopefully you guys found this entertaining, informative.
yes. But let's go ahead and move on to our one rock takeaway. I'll go ahead and take it. My one rock takeaway from today's episode and everything that we've talked about is honestly going to go against a lot of the norm here and what we're seeing from a lot of people. Guys, you have a world of knowledge in your pocket. You literally have access to information at all times. Stop playing the victim card. Educate yourselves. You have the opportunity. If you don't have a phone, go to the library. We can't play this victim mentality anymore that everything's happening around us. And I'll tell you, I used to do that. Everything's happening to me and around me, and I can't control it. It's all bullshit. Take it upon yourselves. Educate yourselves. And I guarantee things will get better for you.
Yeah.
Love it. And a weird segue on that is that I didn't know what the speakers were at my house, and I was a victim of understand my speaker. I went and learned it, and I know exactly where every speaker is in my house, and I timed it, and I got it good. Oh, excellent
Education.
point.
Oscar,
Education.
what's your one rock takeaway?
One rock takeaway. As confusing as interest rates may be, make sure you have someone that can at least give you some kind of information that will make you feel more comfortable and not, I'm just going to shoot in the dark or wait, because waiting usually, it screws you.
100%.
Yep.
Feel comfortable moving forward. Use us if you can, but if not, someone that's knowledgeable, not only in just real estate, because there's a lot of real estate agents that don't know what we're talking about. Ask them questions, get some knowledge, back what Charlie said, move forward with a good foot in front. Good footing, good foundation.
Yep. I like that. That's good. Both good ones. Here's mine. Control what you can control. Okay? Because I feel like people get caught up in headlines and clickbait and noise, which it's great. But at the end of the day, it doesn't matter what headline you guys read. You make the same amount, your debt is the same amount, and you can afford the same amount. So if it doesn't make sense for you to purchase right now, cool. That's good. But don't base that on external factors.
Yep.
Base it on what you know to be true, what you're comfortable with paying, and understand that if you make that decision, more often than not, it's a great long-term decision because time in the market will always beat timing the market.
Boom.
That's it.
Put that on a t-shirt.
That's what I got.
I like it.
I like it.
Jazz hands.
I think.
I like it.
Honestly, guys, I have a dap you guys.
Hey.
No.
This is a challenging episode.
You coined a term. I like it.
It was. It was good, man.
Jamison Amros, ladies and gentlemen.
Passionate, baby.
We're going to put that shit on a t-shirt.
We want to help you guys. That's
Yep.
it. That's what we're here for.
That's what it's about. But
that's why we do what we do. It's fucking
Absolutely.
exciting. I'm sorry.
It is. It is. And
it's confusing as shit. Don't get me wrong.
Dude, I'll be honest,
we were all
you know
double
what?
checking our own what we were going to talk about.
Yep.
I'll be honest. I'm going to say this one last thing. It's fun for us and it's fun for me because we get to have these conversations with the people, whether or not they're looking to buy a house. It's the education purpose. And our job is to make sure you guys are as educated and have as much knowledge as possible to arm yourself to go out into whatever the fuck is happening right now in the market, in the economy, and make an informed decision. And we are all open. If you guys have if you're out of state and you're like, oh, I'm buying a house in Idaho. Okay. Call us. Let us know, dude. Like I've worked
It gives
with,
me no better feeling
No,
to
man,
know that I helped you better your life in any kind of way.
I've worked with people that have been buying in other states that I literally cannot help.
Yep.
Okay. But I've answered questions for them that they go, oh my God, I didn't think about asking that.
The
That's
collective
like the coolest
here
feeling in the world. It really
cares
is.
of what
Yes.
the education you have. We're not getting paid right now
Hell
for this.
no.
Absolutely not.
Well, I'm getting paid in whiskey, but
Getting
yes.
paid.
you know what? I get paid in bubblegum.
and in knowledge.
Yes.
So
Don't hesitate.
we are of the same persona. We like to talk.
And God damn it, if you don't think we're passionate about this shit, you're not
By now,
fucking paying attention.
You're by now.
Yes.
Yeah.
So please take the information we give
Yep.
you. Give us a call.
Let us know, man.
Yeah, I don't care if you ask me, does the paint of my house affect the amount that I can get? I don't care. No question is too small or too big. We're here to help you.
Which
And
means,
this-
how do you get a hold of us?
Oh, yeah. You can reach us at the Mile High Perspective on YouTube, or you can email us at resotr@themilehighperspective.com, or you can call us at
303-578-0263. It will ring any three of us. We also have our own social media. So Charlie, this is my favorite tagline, honestly, of social media, is
That Lifting Agent or The Lifting Agent. Oscar?
So I've been promoting OscarTheRealtor.com. Yes, OscarTheRealtor.com is my website, and I have social media. But a lot of social media is either Oscar the Realtor or OscarTheRealtor.com, just because there are apparently there's a lot of Oscar the Realtors out there.
Brand, baby. Brand.
and none of them are as good as you.
I
so-
hate you
Yeah,
guys.
that's right.
Thanks.
But anyway, so Oscar or OscarTheRealtor.com, Oscar the Realtor or OscarTheRealtor.com
Perfect.
is where you can find me.
Mine's super easy. The Colorado Real Estate Guy. That's on Instagram, TikTok. You can find me on Facebook, Jamison Amros, obviously.
Yep.
But feel free to reach out to any of us guys.
Which I don't understand how that is available. It's
The Colorado
smooth.
Real Estate Guy?
Yeah, it's smooth.
Dude,
it's
I know.
good.
It's
I was
so
like,
good.
geez.
It's so good.
So
I
my
put it
other
in and I was like, wait a second. This is
So, hold
available
on.
on all platforms.
my
Yes.
my alternative website is coolestguyonearth.com.
I mean, I love that one too. do
I
like
bought
that
it
one.
a long time ago and I still have
On
it.
Jameson's note, we like to talk about real estate and give you information to arm you on real estate, but the other part of this episode is the bourbon, baby. Let me tell you. And at the end of the day, it's fun for us to sit here and drink, but I like to think that our reviews are pretty honest. They're pretty straightforward.
They
and
are.
regardless of if I have a 5-star thing or if I have certification, whatever. I've drank a lot of bourbon. I was a mixologist. I talked to a lot of people. I enjoy reviewing bourbon, and we review it specifically so you're not going out and spending $80, $50 on a bottle and going, should I?
Ooh, you know what? Continue.
Because
you guys don't know how much
this
the bottle
is
was.
delicious.
Exactly. And so that's why I want to move on to our bourbon review. And again,
we need like Bruce Buffer. It's time.
I will say, man, Smoke Wagon is tried and true, man.
Dude,
it is
never
they are
disappoints.
so
The reason why
Never
it's
disappoints.
overall, it is my favorite bourbon to drink. Any of them.
Yeah.
I have
And it may not have a history. It might not have
any of them.
It
I
is
don't care.
delicious.
It doesn't matter. It's delicious. I've had now 5 different Smoke Wagons. I love all.
You have a party or you want
Dude.
invite me over for some bourbon? You got Smoke Wagon? I'm going to say yes.
I'm just
Let's
saying.
get
So
some.
now that it has been open, and in all honesty, the reason so you guys know after we get off, we all share JC's pour out of this glass here.
Yep.
And it's really cool because this glass has not been touched and it's been open the entire episode every time. So we all do get that flavor rather than just pouring it. And it is so important, and you guys have heard us talk about it on all episodes, that you let the bourbon open. And I will say, you guys go back to the beginning, I was like, I can't wait for this to open. Yeah, I can't wait for it to open. That at first, that pepper flavor was a little bit light for me, and it was but as I've been sipping on it, that burn that was at the front end, pepper.
Yep.
Right when it hits your tongue during the sip, you get the spices, you get the pepper, then it goes to that butter, that sweetness to it, and then it finishes off with a little bit of the heat and a little bit more of those floral, chocolatey notes, for sure.
So as it opened for me, it morphed into the best way I could describe it: condensed milk, sweetened condensed milk on toasted bread. Ooh. Weird. That's what came to mind for me.
Okay,
It was like toast with condensed milk, sweet condensed milk. It is weird. It's
Nope,
good
totally
bourbon.
get it.
It's delicious.
Totally get
I'm just gonna go say
Yes.
that.
I would say that this bourbon, the complexity matches the complexity of the topic today.
Yes.
So I'm glad that we drank it.
Yes.
Me too.
100%.
There's
I like
a
it.
lot happening, and at the end of the day, there's a result. The result's great, and we get to appreciate it. So
Yeah.
I'm excited.
Absolutely.
Yeah.
It was really good. So I'm going to go ahead and start out with the rock rating. I'm going to get, because of the Smoke Wagon, because I know how I feel about it, I'm going to go ahead and give this one a 3. A 3 rock on it. The only reason I give it a 3 and it's not higher up is now because we've had bourbons that have definitely come through and gone, I got something to show you, right?
Yep.
And Smoke Wagon is tried and true.
What was the last 1.5 we gave?
Oh, man.
Was it Elijah Craig Barrel Proof?
Was it?
I think
the
so.
Private?
I think so.
No.
Private pick?
It was
Either way, we'll figure out.
because we gave it 1.5.
We did.
We did.
Because it blew us away.
Yes.
Whatever, I can't remember what it is now. But to the
Uncle
point,
Nearest. It might have been that one.
No.
No.
Well,
Damn it.
we'll
go
figure
back.
it out. We'll figure it out for
Anyway,
you guys.
yes.
I'll clip it in. I'll
Yep.
put it into the after. But Smoke Wagon, yeah, definitely giving this a 3 just because they are steady. It's consistent. The flavor is phenomenal. But at the same time, there are bourbons that I know could compete against it for a lower cost.
Yep.
What is the cost?
Well, we'll give the rating first.
Okay.
Then we'll cost.
But that's gonna determine my rating.
Well, then maybe we change it after I tell you how much it was. Okay.
Maybe I will.
No, I agree. I'm going to go with a 3, only because I know the 1.5 we give. I can't remember what it was just phenomenal.
Yeah.
But when you're talking about like steady Eddie, I'm going to go and I want to impress some people with some bourbon. I'm meeting somebody. We're doing a bourbon taste for the first time.
Yeah.
This is great.
Any
right?
Smoke Wagon.
And it's Smoke Wagon.
Any.
Fantastic. 3.
Yeah.
Yep.
I am going to go ahead with the 3 as well, just because there's history behind Smoke Wagon for me. It really is a great bourbon just to sip on. As we talked, it opened up different complexities. I enjoy it. The reason I didn't give it a 2 or even better, just because there's that unicorn that we're going to be like, that's a 1, right? It's damn near there, though.
Yeah.
It's a good bourbon.
Yep. All right,
What's the
Jim,
price on it? What's
Drop
the
the
price?
price on it.
$54.
Not bad.
Not bad.
Not bad at all.
Nope.
It's I'd still give it
It's cheaper than the
3,
uncut
2.5.
unfiltered.
It's a good.
It's cheaper than the
it's a good rye.
single barrel.
Well, and that's wait, hold on, whole different point there. Forgot this was a rye.
Yep.
It is a rye.
There is
Ryes are spicy, by the way.
well, not only that, the bite on this as a rye is little to nothing.
Yeah.
That's incredible.
It's kind of like the Larceny weeded, super smooth.
Yeah.
This is the version of that.
Yeah,
Fif-
I was-
$54 for a rye. You could put this in old fashioned easy.
No,
drink it straight
100%.
easy.
It's not a. Yeah,
It's a rye,
Yeah.
Manhattan, baby.
I couldn't do a blind taste test on this and say it was a rye. It's
Yeah.
too, it's too
no,
sweet
it's too
for a
smooth.
rye.
It's too smooth.
Yeah.
Too sweet, too smooth. Ryes
Yeah.
are really spicy.
Yeah.
Hands down, hands out to you, Smoke Wagon. You did phenomenal on this one.
You know what?
Hey, Smoke Wagon, sponsor us.
Yes,
Yeah.
please.
Just saying. You want to fly us out to Vegas? We'll do a podcast in your Rick house.
Down.
Oh,
Just saying.
all day long.
I won't
Please
say no.
do.
I will not say no.
So my favorite spirit to do an old fashioned is actually a rye.
Yeah.
Oh, yeah, same.
Oh yeah. Well,
Same.
absolutely.
Templeton.
Absolutely.
Templeton's rye is like my favorite, but this one would probably lend
We
itself
actually
better.
we haven't done Templeton actually.
It'd be better flavor wise because
Yes.
it has the complexity and the sweetness and maybe less simple syrup.
Yep.
This is good.
100%.
I've never done one with.
Hey,
with
also,
this.
just real quick side note. I can put my feet
You
on
can
the
put your
table.
feet up again. I like it. I like it. Well, guys, thank you so much for joining us.
appreciate it,
on our
guys.
episode.
Thank you.
Like, follow, subscribe.
Yep.
Let us know what you guys think. Hopefully, you guys enjoyed today's episode.
Yes.
Absolutely.
Yep.
Cheers.
Sorry for the confusion or the clarification. We love you guys. Cheers.